Hi folks, this is Sean Hyman from Chart of the Day, and I just want to talk to you today about technically timing bullish fundamentals. In other words, some people think, well, a pair has bullish fundamentals, so it should just pretty much, in the back of their mind, they think it should almost go up daily, money should pour into it daily, it should increase in price almost daily, but that's simply not the case. There are pullbacks, and sometimes sizable pullbacks, even within currencies that have bullish fundamentals. Now, what am I talking about, the bullish fundamentals? I'm talking about Australia versus the USD, US dollar. And, you know, Australia has had things like decreasing unemployment. They've had their employment numbers increase 2 months back to back. How many countries can say that? They've had the only positive year-over-year GDP numbers out of the whole G7. They've got the highest interest rates. They've got some of the highest inflation out there as well. And of course, inflation has to be fought by raising interest rates, and they've done that once, so they've been the first of the G7 to raise interest rates as well. So there's a whole myriad of fundamentals here that have lined up in the Australian dollar's favor. Their consumer confidence numbers have been good, etc. But it doesn't mean that every day is a day to buy the Aussie dollar. So when do we buy the good fundamentals? Well, I mean, this was a good time to be a buyer, but that time's already passed. It's when it's uptrending, when the moving averages are moving up, when shorter moving averages, like the purple moving average, is above the longer term moving average, which is the green moving average. Here I happen to have a 50 and a 100-day moving average, but it could have easily just as been like a 50 and a 200, something like that. But now they have crossed and turned downward, and also let me remind you, this is on a hourly chart as well, 1 hour 30-day chart. So each candle is worth an hour, and it goes back 30 days in time. So we've gotten the cross, and the pair has headed downward here. So there's several things that we would want to see happen here. You know, when do the planets align and we know to hop in this trade? While there is no exact holy grail, one thing we do know, we sit on our hands until this pair finishes trading down and climbs back up above its moving averages and holds some candles there. We sit on our hands until this negative downward slope on the MACD is broken. So what do we want to see? We want to see this negative, you know, this lower highs, lower lows on the MACD broken. We want to see some divergence in the MACD lines come up higher and break this downtrend line. We want to see the price come back above the major moving averages and hold above it. Now, is that a guarantee that the price has turned around? No, it is not. But what is it? It's a statistical edge. It's a high probability that the pair's onslaught, its downward spiral, is over. It's also a sign that the buyers have more than likely taken back over once we see things come back above the moving averages, and so it's a better time to be buying. It's a way to buy to help ensure you're not catching the falling knife, so to speak. You know, if a knife falls off a table, you don't want to try to catch it because you get your hand stabbed. And it's that way in trying to catch a falling market. It's usually not the wisest thing to do at all. It's best to let the buyers come back in, let somebody else initially take that risk to buy it back up enough to where it pushes to where you're starting to have higher highs and higher lows again. And when that happens, of course, it'll be closing and holding candles above the major moving averages, and it will have broken the negative MACD downtrend that we see right here as well. So that is some ways that you can tell better times to enter bullish fundamental plays. Thanks so much for watching. Bye-bye.